Hello everyone and welcome to the Quantpedia Explains Trading Strategies video series. Today we will discuss how to improve commodity momentum.
Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today I'm really glad that I can share the results of our research with you. We will discuss the momentum strategy and I'm really excited of the findings. We will get to the findings very soon. So firstly, let's quickly talk about or discuss the momentum. I mean, the momentum strategies are one of the most popular strategies there are around us, I would say it this way. So we have around or over 200, nearly 250 of them in our database. Promise of momentum is that when you buy the assets that went up for some time, there is a higher probability that those assets will go up for a short period of time in the future. And on the other hand, when you have assets that went down for a long period of time, there is high probability that they will go down for the next future for a very close period of time. That's the momentum. So you are buying the assets that go up and you are shorting the assets that goes down. So that's the idea. Our article about is that we took the commodity momentum strategy and we try to improve that commodity momentum strategy. I mean, the commodity momentum is a subset of momentum strategies. I mean, we have it in our database, it's freely available. I mean, the strategy is using futures, buying the best performing commodity, shorting the worst performing commodities. As you can see from the equity curve, and the strategy was performing well up until 2012 or 15, 16, and then it went into a steep drawdown. I mean, the strategy was hedging very well against geopolitical risk, but from 2016 until 2022, I mean, it had really awful performance, and it really took off only after 2022 when there was risk of scenario when Russia invaded Ukraine and inflation all around the world went up, etc., etc. Strategy started to work a little again, but all in all, I mean, it has its own problems. We took commodity momentum strategy and we tried to improve that. Strategy works well in the crisis periods, so like inflation around World War II, oil crisis in 1973, as I mentioned before, the war or inflation 2 years ago, etc. But in recent years, I mean, the performance of the momentum strategies, or not just commodity momentum, but all of the momentum strategies declined. Momentum struggled to effectively distinguish between winners and losers. It's especially a problem in homogeneous investment universes. I mean, we had the whole article about that, robustness testing of country, and I said ETF momentum strategies. If you are interested, you can read about that. But right now we are discussing the commodities. So our idea was to find some filter that will show us or tell us when to exploit the momentum strategy and when to avoid the momentum strategy, especially in the commodities. A very interesting predictor that we found is the ratio of the short-term to long-term average correlation. So that's the predictor and it works really, really well. I will show you later. So what's the methodology? So we use just the ETFs, not the futures. The reason for that is because it's easy, simple, data are available. We don't need to care about the rolling, etc., etc. And especially for the retail traders, it's easier to use the ETFs than using futures or something like that. So we use the data from Yahoo Finance and our dataset starts in 2007. So we selected those four main ETFs. It's DBA, agriculture, ETF DBB, it's the base metal, sector of commodities, CBE, it's the energy, and DBP is the precious metals. In the first step was to replicate the simple momentum strategy. So we took those four ETFs. Each month we calculated 1 to 12 month momentum for each ETF. We ranked those ETF based on the performance, and the ranking signal gave us the signal which ETF to go long and which to go short. The strategy involved going long the two best performing ETFs and shorting the two worst performing ETFs. So here is the table with the results and here is the chart. As we can see, the blue line is the benchmark. So this is the average performance of the commodity market or the average performance of those four ETFs. As we can see, the green line is the average performance of all of 12 momentum strategies. Yeah, there is some outperformance against the market, so you will get 1.59% compared to 0.76% performance of the benchmark. But I mean, it's not anything extreme. So I mean, most of the time you are swinging in the water and not getting any money out of that. It's only hedged during the stress time. So yeah, during the COVID crisis to 2022, as I mentioned before, there's a time when the momentum strategy works well. What can we do with that? There is one idea we had in the past. You can use the exotic assets. You can use some low turnover or low liquidity assets instead of ETFs. and you can get higher performance. I mean, we used this tactic in a futures strategy in the past article. I mean, we wrote that article probably 2 years ago, and we were able to use the liquidity premium, and we were able to improve the performance of the commodity momentum strategy. But I mean, in this case, I would not like to use liquidity or less liquid assets, so we just want to stack B and stay with the ETFs that we selected, so 4 ETFs. So we need to find out something different. I mean, turning to low liquidity assets is not the option, so we need to find an alternative way. The next step in our analysis involved calculating average short term, with measured over 20 days, and average long term, measured over 250 days, correlation from the daily performance of the 4 ETFs. So we calculate correlation each ETF to each ETF. So we will get 4 correlations altogether: ETF A to ETF B, ETF A to ETF C, ETF A to D, and then B to C, B to D, and the last one is C to D. All in all, you have 6 correlations. From those 6 correlations, you will calculate the average, and that's the average correlation over the 20 days, and you will, if you take data for a longer period of time, for 250 days, you will get longer term correlation. And now here is the idea. So if the short term correlation is higher than the long term correlation, what does it mean is that in short term commodities, or I mean commodity sectors, are trending in the same direction, or at least they do not need to trend in the same direction, but they are starting to look more like each other. So I mean they are more correlated to each other. And I mean, this is the time when the momentum works the best, because it can select the ETFs that are performing well and they are outperforming, and it can go short the ETFs that are not performing so well. In case the short-term correlation is lower than the long-term correlation, I mean, this is the time when the market doesn't know where to go. So I mean, one ETF can go strongly up, another is going strongly down, but on the other hand, the one ETF that was going strongly up is going down, and the one that was going down is going up. So I mean, the market is not especially sure what is the direction, and for momentum it's very hard to select which ETFs are the winners or will be the winners in the future, and it doesn't perform very well. So in this case, when the short-term correlation is higher than the long-term correlation, it's better to use the reversal strategy. So here we have the results. So as shown in the table 2, the correlation predictor leads to more or better outcomes compared to the basic momentum strategy. If we take the momentum strategy only when the short-term correlation is higher than the long-term correlation, the correlation filter helps us to select the periods when the momentum strategy works the best, and the average performance of the momentum strategy significantly improves. So from 1.7% to 5.6%. So it means that we improve the strategy by 4%. We have better performance, lower drawdowns, lower volatility, higher Sharpe ratio, higher Kalman ratio, and is robust. So it means it doesn't matter if it's 3-month momentum or 9-month momentum or 12-month momentum or whatever. This predictor works very well in all of the time periods. Now, and let's take a look on the other side. What happens when signal tells us, yeah, it doesn't make sense to invest in the momentum? Here we can see that on average, the momentum strategy during that time when the short-term correlation is lower than long-term correlation has a negative performance, and it's really significant. Once again, on average, every time the short-term correlation is lower than the long-term correlation, every time the momentum strategy loses the money. So it means we can, instead of momentum, employ the reversal, and it will be much better for us to use the reversal, especially when we have the 12-month period. During the 12-month period, when we employ the reversal strategy instead of momentum strategy, we will not get the minus performance, but plus 7% performance, which is, I mean, very, very interesting. I mean, this insight, so the insight that we can use the correlation filter to distinguish between the momentum periods and the periods when it's better to employ the reversal strategy, leads us and open the door to a new strategy. So based on this finding, we can switch between the momentum and the reversal. So we can use the filter, we can calculate the correlation, short-term and long-term, and the short and long-term correlation will tell us if we should apply a reversal strategy, so going long on the 2 worst performing and short on the 2 best performing sector ETFs, or on the other hand, to employ the momentum, so going the long on the 2 best performing and short on 2 worst performing commodity sector ETFs. And when we combine those 2 strategies together, we have very interesting performance, because we have the strategy with a performance of nearly 14%, volatility 16%, maximum drawdown minus 27%, Sharpe ratio 0.8, Kalman ratio 0.5. What is the advantage is that this is a strategy that's built on the commodities. So it's completely unrelated to equities, to fixed income. It diversifies very well, so you can put it into to an ordinary portfolio, you can have a great diversifier to, ordinary portfolio. And it is easy. You just need to use the ETFs. You are going long 2 ETFs, short 2 ETFs, and you are just switching. With ETFs, you are long and you are short. That's the result of our analysis. I hope that you liked it. I really liked what is the result. I really liked, how simple it is. And I really like the predictor. It really makes sense and it helps a lot. And we are happy that we can share the results with you. We will continue using this predictor because I personally can see a lot of the venues and a lot of the ways how you can use this predictor and improve all of the other momentum strategies that are all around and that are used. So I'm looking forward to the future how we will use this predictor. I hope that you liked the current video. Please give us the like. Feel free to ask anything in the comment section of the video. Do not forget to subscribe to our channel. And if you are interested into the more quantitative research, visit our site quantpedia.com. And I hope that you will join me in the next video. Thank you very much.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.